Good morning, and thank you very much for joining us for this week's first webinar in the Rated by Kepler series. I'm Joe Litchower from Kepler Trust Intelligence, and today we're going to be turning our attention to global equity income. And in just a moment, we'll be hearing from Martin Conahan on one of the fund managers of the Murray International Investment Trust. So before I hand over, just a very quick word on the format for those who may be new to these sessions. Martin's going to be speaking and presenting on the trust for around 20 minutes or so, sharing an update on how the trust is positioned. And after that, we're going to be moving into a live Q&A session where we'll aim to cover as many of your questions as possible after the presentation. So if you do have any burning questions now, or if anything comes to mind during Martin's presentation, whether it's about the trust itself or the broader market environment, just drop the questions in the Q&A box in the bottom right hand of your screen and we'll get to as many as we can at the end. With that said, Martin, it's an absolute pleasure to have you today. Over to you.
Thank you, Joe, and thanks for having me, and then thanks everyone for joining us this morning. I will rattle through the presentation, give you a little bit of an update in terms of what's been driving performance and some of the changes that we've been making, and then get into some Q&A towards the end. So if we can move on to the next slide, we start with the investment objective. It's what we start every presentation with. It's what guides us. It's what we're tasked with delivering for our shareholders, and it's really what sort of guides us through times of market stress or when the market can get a bit euphoric. It doesn't really matter. What we're always focused on is this, because this is what we tell shareholders that we are going to deliver for them. And the objective is to deliver an above average dividend yield, above average being above the average of the global equity income sector as classified by the AIC, and then to grow that dividend and capital in real terms, so ahead of inflation, over the long term by investing in a portfolio principally made up of global equities. We've managed to grow the dividend for 21 years in a row. And last year we had managed to enhance our considerable revenue reserves, which currently stand at 85 million, which is as near as makes no difference one full year of dividends. And the dividend cover was 1.12 times. And what we mean by that is that we actually do try to cover the dividend that we pay to shareholders. We don't cover the dividend from capital. There's nothing wrong with covering the dividend from capital, but it just does lead to quite different outcomes, and I'll touch on that in a second. Managed to grow the dividend ahead of inflation in 16 of the last 21 years at a compound annual growth rate of around 7%, and NAV return ahead of inflation in 15 of the last 21 years, and a total annualized return of around about 10% in sterling per annum. If we move on to the next slide, and this gets into that outcome from trying to cover the dividend and how it can lead to quite interesting and quite unique sort of style or characteristic outcomes with regards to Murray International. What the scatter chart here shows is where a smattering of global and global equity income trusts and a global equity benchmark sit in terms of their style, in terms of their characteristics. And many of them tend to fall within that core or towards the sort of growthier end of the market. Because we try to cover the dividend, that means that we do need to have quite reasonable exposures to the higher yielding areas of the market. And, we have reasonable exposures to telecommunications and healthcare and utilities and banks. We tend to be quite underweight to the United States and instead diversify better and take advantage of, in our view, higher yielding and better value opportunities, places like Asia and Latin America. And that tends to make the portfolios, as scatter chart shows, more value-based. And that isn't something that we set out to do. Again, it's the investment objective guiding us, and it's delivery of that investment objective that gets us there. But when we meet with shareholders, they tell us that they're actually quite pleased of that. They are pleased to have something that looks and behaves a little bit different. They tell us that they're not short of gaining access to the growthier areas of the market. It's quite a busy area of the market, as the slide shows. And whether that's via active allocations or passive allocations or direct stock ownership, all of which actually when combined can result in quite a bit of overlap potentially in terms of holdings. We're trying to deliver something different, and the portfolio looks quite different as a result of that. If we move on to the next slide, there's no point really being different if you're still not really giving desired outcomes. There's no point just being different, but you're not giving clients what they might expect from that allocation. And as this slide shows, over the long term, Murray International, in terms of its total return in sterling, has managed to deliver returns ahead of both, standard global indices or even high yield indices like the MSCI ACWI high dividend index, which is actually, our benchmark. And it shows really what we believe in. We believe in dividends. We believe in the power of dividends and how much dividends and the reinvestment of income, over the long term, and that compounding effect, it can really be very, very powerful in generating, and growing wealth, over the long term. So it's all well and good being different, but we obviously want to be delivering, desired outcomes for our shareholders. And the chart shows that, over the long term, we've managed to do that. Now, through that very, very long-term chart there's obviously been very, very different market environments that we've had to negotiate. If you think about the market and government and central bank response to, for example, to the global financial crisis, that period of, I would argue, abnormally low or no interest rates, abnormally low or no inflation, and the market being very, very much focused on hyper growth and everybody's investment time horizons way in the future. That's not a great environment for a portfolio and an investment objective such as ours. And that's fine. Obviously, the path that we've been on more recently, since COVID, and I would argue this has been a more normal environment, where we've had interest rate cycles, when we've had inflationary cycles, and we've had market cycles as a result of that. I would argue that that's a more natural and a more normal environment, and that's an environment that sort of suits this portfolio and this investment objective far better. We can't control the environment, and the one thing I would stress here is, regardless of the environment, even in that very long time period post 2008, we do not change how we manage the portfolio. The investment objective is the investment objective. It is not mine or my colleague Samantha, who manages the trust with me. It is the shareholders' investment objective given to us via the board. So we do not deviate from that, regardless of what's going on in markets. If we move on to the next slide, and unfortunately we only update our presentations on a quarterly basis, and 2 months is an age in these markets and the markets that we've been trying to negotiate this year. So we'll use the slide to sort of cover the first quarter, and then I can certainly update more recent events. It was a very kind of robust start to the first quarter, on top of a very robust year last year. And certainly in the start of the year, and the first 2 months of the year, certainly the market sort of shape, if you like, was very, very similar to what had been evident the prior year, last year, that being that market participants were very much looking away from the United States, looking away from large cap tech, and we're looking at other areas of the market, be that in Asia, or as we can see here in Latin America, being the strongest performing region of our portfolio, where we have 8% of the net asset value of the trust. And that was the same the prior year. It was Latin America that was the driving force from that regional perspective, if you like. March happens, the conflict in the Middle East happens, and that very much reverses. You go into March, the US is the only real market in town, really. Europe becomes quite weak, given its proximity to what's been going on. Elements of Asia being quite weak due to sort of net import sort of status of many of the countries that reside there. And it's very much US and energy that were the only place to be in terms of March. More recently, again, as we've been sort of trying to negotiate if and when, and then again, if and when there will be an end to what's going on in the Middle East, the market's been, rotating quite severely at times between very much risk on and technology coming to the fore. or very much risk off again, and some of the more defensive areas of the market's outperforming. So it's been a very, very noisy, first 6 months to the year, all things considered. But the trust through that, NAV return to the end of May was just about 10-11%. So still delivering, reasonable absolute returns in that environment. If we move over to the sector level, and this will really show the sort of degree of rotations that I've just been talking about. Yes, in terms of the first 3 months of the year, we can see the impact there from the conflict really, really driving strong performance from the oil and gas areas of the market within energy. Up 36%. And then also basic materials and metal and mining stocks, also having a very, very solid start to the year. Interesting below that, though, that it's actually, or it was to the end of the first quarter, some of the more traditionally defensive areas of the market that were also performing quite robustly. Telecommunications up mid-teens, utilities, healthcare, areas of the market that had at times lagged last year, getting off to a fairly, robust start to 2026. But then look at the bottom half, of the slide. Many areas of the market in negative territory at the end of the first quarter, one of which being technology. That rotation that I was talking about earlier, now if you look at the end of May, the Trust's technology exposure is up over 30% in absolute terms. So really, really driven by the AI trade and some of the semiconductor names that we expose our clients to in terms of the technology exposure. So really, really, wild movements within the equity markets at times from the first quarter into towards the midpoint of the year. Now there has been a lot of movement and rotation within markets, really driven by sentiment, really driven by conflict. Things are very, very difficult for investors to really gauge the sustainability of what's really been driving markets at times. So it's certainly not been the easiest of environments. But again, as mentioned, the Trust trying to, being as well diverse as it is, across the industries, across the geographies, still managing to, keep pace with that. If we move on to the next slide, some of the transactions that we have been up to in terms of the first quarter. So topping up in top slices, that would just be adding to or taking away from existing holdings within the portfolio. The top slice is really just driven by strength in the portfolio, reducing the technology names that we have, Samsung Electronics, TSMC. We've continued to do that after the end of the first quarter and continue to do that even up to this month, reducing names like BE Semiconductor, Hon Hai in Taiwan, Broadcom in terms of the United States, because those are really, lower yielding areas of our portfolio. And if we are, I wouldn't say concerned, but we have to be mindful of further upside in a name that isn't really delivering on the yield, because we have to be honest and admit that it's there to deliver the capital side of our dual investment objective. And if we have question marks around that, then we certainly have to be mindful about the overall weight that we have to these lower yielding areas of the market. So we've continued to take them down. We also reduced the oil and gas exposure. You want to be really selling down your oil and gas exposure, we believe, when, oil prices and gas prices are elevated, particularly if that's driven by conflict risk, because it tends not to last. And it is a very, very difficult thing to gauge the quantum of it, what's really embedded in the underlying price and if and when that goes away. So you really want to be buying oil and gas prices when it feels, or stocks when it feels horrible to do so, when oil's at, south of 60 and the prices are depressed, and you want to be reducing it when prices are elevated as they have been. So we did take some money away from Total Energies and also Shell, just into that price strength that we've been seeing. In terms of topping up, you can see that I've been adding to a number of the healthcare stocks that we have in the portfolio, many of which reside in the United States. The earlier slide shows that tech had a reasonable start to the year, but since then, as the market has rotated, it has also continued to lag as it did last year. We still like healthcare longer term, particularly in an income mandate such as this. The sustainability of the dividends, the growth in the dividends, and how well they are backed up by the strong cash flows of many of these companies. So we've been using some of the absolute relative weakness within healthcare to maintain those positions that we have to the pharmaceutical stocks that we can see here. We also used a little bit of the weakness that was very evident in Europe when the conflict began, just given proximity to what's been going on, reliance on oil and gas from that region and concerns about that impacting on growth, impacting on input costs. So adding to some of the industrial names such as Kony, discretionary names such as Inditex, financials, both in terms of banking stocks in Italy via Intesa, on the insurance side as well as Zurich. So just taking advantage of some regional weakness that we were seeing within some of the European names within the portfolio. Divestments, you can see here a Mexican bond. I should really mention that we do have the ability to invest in fixed income securities at Money International. Now, that's only an allocation that we've really used in scale twice over the last 25 years. We used it in the early noughties when the equity market yields are quite tight everywhere, and we're tasked with covering a dividend of 4%, 4.5%. So at that point we took the portfolio up to about 20-25%, both in treasuries and gilts through 2004, 2005. Then you have the GFC. And equity yields are working for you again, so that position gets sold down very quickly and rotated back into the equity market. We did it again through 2014-15. By that time, it was really in emerging market debt securities, which were selling off quite violently as a result of taper tantrum concerns within some of these emerging economies. So we took it back up to a weight of about 16 or 17% at a peak. In emerging market debt, both government and corporate debt. It was done again with delivery of the investment objective in mind. It's not that Sam and I take views necessarily on gilts or bonds versus equities. It was really done with making this allocation shift, deliver the investment objective. The direction of travel the last few years has been to sell that exposure all the way down. It's now at 1.5% of the portfolio, and it will reduce even further. In the second half of this year, we have 2 Indian corporate bonds which are due to mature in the second half. And as this slide shows, in the earlier part of the year, one of the Mexican bonds in which we had invested also matured. So it's something that's available to us, but all other things being equal, we want this to be a portfolio of global equity. It's just far simpler for everyone to really understand what they're exposing themselves to. On the purchase side, you can see Blackstone there. And now obviously there's been a lot of concern across private credit markets at times, and that's been weighing on sentiment around some of the alt managers. And we share those concerns. We do, and we think that that noise could certainly continue from some time. When it comes to Blackstone, no, we are sort of a little bit more comfortable around the scale and the diversity of the business model. Yes, there has been flows with regards to private credit funds, but they've managed to meet all of those obligations. And while the flows have been challenging with regards to the retail side of the business, on the sort of institutional and insurance side, which is about 3/4 of their AUM, flows have actually been far more robust, seeking out exposures to some of the infrastructure plays, the energy transition funds that Blackstone offer, and it's on a very, very attractive yield, particularly in a US context. So that's a name that we have bought, may well be early on, and one that we'll continue to monitor from here. And if we do get a chance to further add to that position, all other things being equal, then we will continue to do that. So that's a sort of summary in terms of the first quarter and some of the activity in the portfolio. And I'm happy to take some questions if there's further points to be made with regards to recent activity. If we move on to the next slide, and this is just a summary of the top 10, and it is a mixture of, higher yielding and lower yielding opportunities, that almost barbell effect, if you like, to approaching delivery of that yield. We do expose ourselves to higher yielding areas of the market so that we can, on the other side of that, take reasonable exposures to some of the lower yielding opportunities, which should help with that dual mandate of income, but also capital growth. The other thing that I would flag with regards to the top 10 is that we are allowed to invest up to a max of 5% of the portfolio in any one name. And, very frequently we usually have one or two names that are pushing up against that. We do like to build a high conviction portfolio and really back the views that we take on stocks. But you'll notice at the moment, we're sitting slightly above 3%. And I think that's just, I guess, indicative of the market environment and how difficult it has been at times, given the wild swings that we've been seeing, to be having, that degree of conviction that you would want to have, to be taking, 5% positions in an absolute context. But in terms of businesses, a number of US names there, but other companies in Asia and Latin America, and a mixture of growth and yield opportunities there also. If we move on to the next slide, we can see that, that underweight that I referenced earlier, that has to the United States. Our portfolio is built from the bottom up. We don't take top down or, those sorts of views on markets. We have to do a sense check, obviously, at the end of the day, once the portfolio is constructed. And it genuinely is not that we are negative on, the United States. The United States is our single largest country, and it is as high as it has ever been. But when you have indices, getting over 50%, some now over 60% within one area of the market, particularly when that area of the market is a lower yielding area of the market, it's not too difficult a position for us to shake out at, to be underweight that market and make full use of that global remit that we have, and to explore stocks in Europe and Asia and Latin America. And at the moment, we do find what we believe to be either better quality or better value or better yielding opportunities, or hopefully all three, in other areas of the globe at the moment. And we have those overweights to Europe and Latin America and Asia, as you can see. Nothing in Japan. That isn't for want of hunting or trying on our part. Some of the companies that we find there, unfortunately, the ones that really intrigue us are just a little bit too small for us in terms of us being able to acquire the sort of position size that we would wish, or where we do perhaps see levels of consistency on the yield or the dividend growth. It's very similar business models to which we already have, whether it be a bank like MUFG or a telecommunications stock like KDDI. What we really want to do is find unique opportunities when we're scouring the globe and the industries for stocks. But there are a few names on our watch list, so that could well change. So we're always on the lookout for new opportunities within Japan. And then over the slide, we've got the sector level. And beyond highlighting really telecommunications overweight and the industrials underweight, both of which are really driven by yield or lack thereof. So yeah, we do need to have that, that overweight to telecommunications stocks and get that certainty and level of yield, which allows us to take, positions in lower yielding and potentially more growthy areas of the market. There is nothing more or nothing less than that driving the telco overweight. And likewise on the industrials, some of the industrial names that we do like, many of them just have a level of yield that is not quite high enough for what we would require, given that we maybe already have our sort of that capacity for lower yielding names getting taken up by some of the technology exposures within the trust at present. But again, it is not for want of hunting on our part. Beyond that, you'll notice that the relative positioning at the sector level is actually quite benign. Again, it's a bottom-up process, and we tend not to take overly aggressive, bets at the sector level beyond that yield requirement from telcos and industrials. But well diversified across all the sectors. As we can see, the only area that we don't have any exposure at the moment, is within that real estate. I guess in terms of things to cover, that was really, all I was going to cover today in terms of the portfolio, the trust, what it is, but also what it's not. So I would much rather spend as much time as we have answering any questions on the trust or markets generally. So with that, I'll pass back to Joe to manage that process. So thanks.
Fantastic. Thank you, Martin. I think that was a really insightful update, particularly on how the trust is positioned in light of current markets. Yeah, we've got a couple of questions on the trust specifically, a few more on the broader market points. So we'll cover off the trust first. You did speak about Japan being there waiting, and there are a few companies on your watch list. I guess with that evolving dividend culture that we've seen basically since the turn of 2020, that kind of push, that governance push, has been ongoing for much longer. What areas are you seeing the most improvements, and what areas are kind of piquing your interest in Japan at the moment, that perhaps feature on your radar?
Yeah, it's been so interesting to see that, because prior to that, we had been frustrated many times, with the Japanese companies sort of backtracking on previous noises about, we get it this time and shareholder return and, cutting dividends, when, especially when you look at the cash that so many of these companies have on their balance sheet unnecessarily. But this time is absolutely different. There's no question about that. And you're seeing that across the sectors. The areas of Japan that we really kind of like are within more of the sort of industrial space and
Right.
within the factory automation side of things. So businesses like Fanuc on the robotics side, or KNX on the sort of factory automation and sensor side, they're fantastic businesses. Some of the medical equipment businesses are very well managed. Names like Asahi and Tech are a really good business. Sysmex on the med equipment side as well. Some of the other companies that we've been looking at that are just not liquid enough for us, which has been frustrating. Things like Sankey Engineering, Kandenko. There's a number of businesses which are definitely ownable. It is just a case of, right, okay, where are we funding it from? Where are we sourcing the capital from? Is this something different to the portfolio and something better to what's already in the portfolio? And how are we with regards to the timing of it? Because it has obviously been a particularly strong area of the market. But yeah, I think this is definitely different this time with regards to Japan. And in terms of areas that we like, those industrial names, those factory automation names, those are areas of Japan which we're very keen on.
Okay, great. And within your Latin America exposure, I guess a good question is how much of that is Brazil? And given the rates have come down recently and there's an upcoming election in October, what are your thoughts on the kind of outlook there and the opportunity set there in Brazil?
So yeah, it's about that. It's about 2.5%, and it's really
Okay.
only two names. One is Telefonica Brazil, again, just
Mhm.
to help us with the yield side of things, and then the other one is Vale, to sort of have one of the higher yielding, lower cost, high quality iron ore producers within our metals and mining exposure. When we look at names like BHP or Rio, fine companies, and we own them, but we want to have an exposure to one that really gives us yield within that. So it's Vale on the iron ore side. So yeah, the rest of the Latin American exposure is within Mexico. But as it relates to Brazil at the moment, yeah, there is always political noise
Mhm.
that we have to sort of contend with. Our approach to it is really to always try and look through it as much as is possible, because it comes and goes and it ebbs and flows. And not only do we have to contend with that in Latin America and Brazil, but we're having to contend with it in the United States. We're having to contend with it in the UK this morning. It used to be a thing that was far more frequent within emerging markets and caused far much more noise within emerging markets. But I struggle to think of a geography of the globe where these things aren't playing a part at the moment. So we try to look through them and just accept that there will be bouts of volatility, particularly in the currency. And as long as there's nothing directly impacting on the stocks, then we tend to sort of stay the course. So our
Mhm.
Latin American exposure has probably been one of the more stable exposures in terms of the scale of it for us. And it's a cliche, but it's really about, if you found the company, have the time spent being invested in the market
Mhm.
as opposed to time the market, because sentiment will come and go, flows will come and go, but if you can just sort of not necessarily get distracted by that,
Mhm.
that time spent in the market, the Latin American returns over the long term have been very attractive for this trust.
And moving to kind of a bit of a sector perspective, you've obviously got a small overweight in the technology and healthcare space, which is obviously on the chart in front of us. So, what views, if any, do you and the team have, particularly on the healthcare stocks that are positioned to potentially benefit or profit from that integration and utilization of AI?
So the healthcare's, we were lucky enough to have a dedicated healthcare team, which are based out
Hmm.
in Boston, and we rely on their input and research, very much so. All of our healthcare exposure is basically within large cap pharmaceutical companies listed in the US, so Merck and Johnson and Johnson and AbbVie, and a lot of them are actually really sort of contending with. Most of them are actually contending with, patent cliffs or upcoming patent loss of exclusivity cliffs in terms of the very recent future and probably out to the end of this decade. So a lot of the time for us is spent on where they are with their pipeline. Are they, what's their track record like with regards to R&D, or do they have the firepower to buy in pipeline? The opportunity for AI to, help these companies be far more efficient in that regard, and to help on the cost side, particularly if and when these loss of exclusivity events can cause pressure on the top line. But it has been an area that's been well out of favour, and we always tend to look for opportunity in areas of the market which are being ignored, because I think that is where opportunity presents itself. And if you think very, very longer term and demographics and ageing populations, yes, there will always be question marks around pricing and the regulatory environment. That doesn't tend to go away, as with the political noise that we were talking about. But I think AI for them, represents a real opportunity for them to be more efficient, to manage costs, particularly on the R&D side. Which, when there are patent events, can help them maintain margin, maintain profitability, and as far as we are concerned, maintain dividends.
Fantastic. And I guess kind of moving to the rating, the trust credentials, strong performance of late, that's seen it shift into part of the reason it's seen it shift into a premium rating. But when the trust has operated at a discount, are kind of share buybacks done when opportunity allows, or is there a policy or process behind that?
Yeah, no, I mean, obviously the last couple of years for the industry, there's discounts have been something that we've all had to contend with, and throughout, last year, and the year prior, we were out there consistently buying back stock, all the way out. I mean, our discount was out at, low double digit, I think, at the wides, and we were aggressively, buying shares back. I think we bought about 11 million shares, give or take, last year, which is 30-40 million quid's worth, and the same the prior year. So we were aggressively buying back in that environment, as we felt we should be. We are, as from the portfolio management perspective, am I comfortable buying back this portfolio of stocks at an attractive discount for existing share? Absolutely. It's very important for us to be there to provide liquidity for shareholders that are looking to exit as well. And it's something that the board monitor very, very closely. So, we were buying back quite aggressively in that environment, as we should be. Now that we're back and have been issuing stock at times this year, what we'll probably do is narrow those parameters to where they were previously. And so should we go back out to, some, say somewhere in that mid-single digit multiple discount, then I would expect us to be looking to again look to buy back, because we want to manage that. We don't want to get too wide. But certainly, we're always comfortable doing that from the portfolio management perspective. But it is nice to be where we're at present, which is to be, in a position to be issuing stock on an occasion, because it's been a long road getting back to that.
Absolutely. And I guess on that front then, before we move on to some of the broader market bits, in your view, in your own words, the kind of what differentiates Murray International the most from other global equity income trusts at the moment?
I guess it would be just that slightly more value tilt that we end up at. And it's not that I'm not a value, it's the only thing we ask ourselves is, how can we deliver this investment objective? And it's the objective that guides us and holds our hand when times are tough, and it's really is that gets us through the challenges that markets throw at us. So it's that outcome that we do, and covering the dividend. It just leads to that sort of unique sort of style in terms of the characteristics, being that slightly more probably a bit more defensive. We don't mind if we preserve a bit more capital on the upside and the downside. We also don't expect to deliver every bit of upside on the other side of that. There's other vehicles that will give our shareholders that. There's other stocks that will give our shareholders that. But if you can preserve capital into a shaky market environment, you don't need to work as hard on the upside. So having that little bit more defensive, or a little bit more ballast within our portfolio, as a result of these exposures that we take to deliver the investment objective. I think that slightly more value style and that sort of defensiveness, if you like, is what really does differentiate us from some of the peers who do the covering of capital. And as I mentioned earlier, there is nothing wrong in covering a dividend from capital. It just leads to different outcomes. If I wasn't tasked with covering the dividend of Murray International, would the portfolio look as it is? Not would. So it's just a different outcome, and as long as everybody's aware of that, then as they are, then it's not a problem. So yeah, I think that sort of value tilt, that defensiveness, I think that's the sort of biggest difference between us and the other funds within the asset class.
Interesting. And you noted there that obviously there's been a few challenges as well over the past year, one of which being the conflict in the Middle East. You've touched on that already, particularly with the surging energy prices and some trimming that you've done. As a result of energy stocks performing slightly well, I think it was Total and Shell. But it'd be really good, Martin, to kind of get a sense for how bottom-up investors such as yourself and the rest of your team factor that kind of geopolitical risk into portfolio construction, because obviously you don't want to be focused on it, completely 100% indefinitely. It's bottom up. You're looking at the company fundamentals first and foremost, but you have to be aware of what's going on around you. So it'd be great to kind of get a sense for how you and the team manage that, particularly given what's going on over the last 12 months. And then touching on maybe some of the areas of the portfolio that you think are particularly exposed or even protected on the other hand.
Yeah, 100%. I mean, we can be very much bottom up, but when you're looking at an oil and gas stock, to your point, or a metals and mining stock at some point, in the analysis you have to then be getting into supply and demand and GDP growth and expectations and all that sort of slightly more macro driven stuff. And it's probably more evident in those industries than any other industry, even for a bottom up investor such as ourselves. How we'd look to do that is that we're very, very lucky at Aberdeen. We have our own global macro research team, a team of economists, a team of political analysts. And what they do is they came up with a range of outcomes with regards to what they see as being the main potentials to happen. They will incorporate, what's been going on in the Middle East and the various outcomes there. Is it going to be a deterioration? Is it going to be are we going to see a quick resumption or a resolution? And they will apply, probabilities in terms of their view to that. You then take the macro team's predicted outcomes in terms of how this could play out. What they don't do is say this is what's going to happen. They have a range of outcomes and say these are what we think the probability is, and this may be your base case. We can take all of them and then run scenario analysis using risk systems based upon it. So one of them would have been something like conflict risks dominate, and that's certainly what happened, in March. And from that, you would see, or you would input into our risk systems the market moves, some of the market moves that we would expect in that environment. Probably US outperforming, dollar up, oil north of 100, and you can put a few and into the system, and then it will sort of come with a range of predicted outcomes across the regions, across the sectors, and across the stocks. We can then use that scenario analysis to sort of come up with a rough idea of how we feel the portfolio might behave in that environment. And one of the things that was flagging to us was that in the conflict risks dominate, that it would be potentially a tricky environment and a relative context for the trust, because while we have, as the slide here shows, we've got nearly 9% in energy, that's actually underweight our high dividend benchmark, which has 12. So it flagged that up to us that, are you comfortable with this? This is a sort of potential quantum loss of absolute or relative performance that you could be talking about here. And it just forces you to address some of those issues and be mindful of some of those macro and political impacts that can have such a wide impact on not just these stocks, but the portfolio. So we like to use that sort of skill set that we have internally at Aberdeen and plug it into, some of the tools and the risk tools that we have at our disposal to make sure that we're aware of those risks that you highlight.
And I guess those tools will be used in similar fashion to things like rates and inflation, because we've obviously seen the pathway, the direction of both rates and inflation look complicated, I think is fair to say, for the rest of this year, given those higher energy prices and the conflict in the Middle East. So perhaps a little bit of a two-parter, with inflation potentially looking stickier or even increasing thanks to those energy prices. How do you think that's impacting the portfolio? And then from a rate perspective, obviously a higher for longer rate environment may increase the appeal of those risk-off assets like we saw in 22, 23, bank deposits and high yielding bonds, for example. But do you see kind of investors turning towards that despite trust like Barry International offering kind of that dividend growth above inflation and that capital appreciation that bank deposits can't match?
Yeah, I mean, it's very, very interesting. Just thinking about the UK or the US and what we've been seeing recently with regards to announcements from the central banks, and Bailey saying that risks around rates were still sort of skewed to the upside with regards to the Bank of England. I mean, it is possible that upcoming increases to household energy bills, could trigger some wider inflationary pressures within the UK. And which could potentially feed into a rate hike potentially in September. I mean, as a house and that team that I was referring to earlier, we're just a wee bit more sceptical that firms and households have enough wage and or pricing power to sort of deliver that material second round impact on the inflationary side. So we'd have the view actually as a house that rates in the UK are actually on hold for the rest of this year, with the potential for a sort of getting back to cuts next year. And I think same with the US as well. The thing that's, we're of the view that the Fed's on hold, and really just driven by the lack of overheating within the labour market. Now, obviously, a resumption of what we're seeing in the Middle East could completely upend that. But where we're at today, that lack of overheating within the labour market, things looking like they may be coming to some sort of resolution with regards to the Middle East. Yeah, we have inflation easing to an extent and rates on hold, both with regards to the US and the UK. How we approach it from the stocks, taking inflation first, right? Okay, well, we have inflation, but where is it coming from? And where are the risks and where are the opportunities? Okay, so if it's coming from commodities, are we exposed to the extent that we feel we should be? Which commodities is it? How sustainable is it? Are we comfortable that we're not buying into these at the wrong time? And then also, what are the risks with regards to inflation? Let's look at our staple stocks, for example. How are they with pricing power? How are they with their input costs? Can they stomach this? Are their margins going to come under pressure? You'd want to be mindful of discretionary exposure, which we're typically underweight also, because the consumer really, really has been feeling the pinch. And then with rates, again, at the sort of stock side, okay, well, where are we with regards to, our banking exposure and insurance exposure? Who can be an opportunity with regards to the portfolio, or something like a CME in the United States, which a huge part of its business is to help, market participants manage interest rate risk. If there's question marks around that, then volumes can be very, very attractive for a company like CME, and that's an opportunity. But again, there's also risk. So let's go to the more indebted areas of the portfolio. Let's kick the tires off the utility stocks and make sure that if rates are on hold or going up, that there's no potential issues in the portfolio. So, again, we'll listen to the views of our macro specialists internally with regards to their view on a direction of travel. For us, we will then take that and take it to the portfolio and be more granular with regards to both the risks and the opportunities with regards to inflation and rates.
Brilliant. Fantastic, Martin. Yeah, I think that's a really nice roundup, actually, covering some of the trust specifics you did in the presentation and in the Q&A, but also the wider market backdrop. And I think it's certainly clear that it remains volatile. And I think this is where kind of active management and bottom-up stock selection comes into its own in these kind of environments. But for now, that's kind of all the time we've got on the Q&A front. Just a big thank you for those that have submitted questions. Much appreciated, as always. But for any of those on the call who would like to explore the trust in a bit more detail, I would just say that Martin and the team at Aberdeen publish a really wide range of material on their website, both on the trust itself, but also on broader market insights. So I'd certainly encourage you guys to go and take a look at that. And yeah, before we wrap up, Martin, just wanted to say a big thank you to you for presenting today and sharing your insights. I think it's been really, really good and a valuable session.
My pleasure.
A real pleasure to have you on today's webinar.
Thank you very much, and thanks for everyone for joining us as well.
Brilliant. Well, yeah, that does bring us to the end of today's session. We do hope to see many of you for the rest of the upcoming webinars this week. But with that, thanks again for being with us today. Take care and goodbye for now.